Okay, welcome back to Beyond the Deck. I am Beata Rouleau, founder and CEO of Compass, where we specialize in helping B2B SaaS businesses scale their revenue. So if you're a CEO that's looking to scale without the chaos, you can always book a free consultation with our team using the link in our description. So today we are joined by Tony Groom. He is the managing partner at K2 Business Partners, where they specialize in, they're a turnaround firm that helps financially distressed companies turn into high performing, high value businesses. So fascinating industry, something that if you're a business leader and you are interested in what it takes to rescue your company, how you can actually convert that into scaling, Tony has a ton of experience. So please tune in, listen to all of his amazing knowledge he's going to share today. So Tony, welcome. Would love for you to do an intro and just tell us a little bit more about yourself.
Cool. I was lucky enough while I was in the army to set up a business. And so I sort of found business early on in life. I was sort of from a service background, so I wasn't a natural businessman from my upbringing, but I discovered money. So, I wanted to learn more about business, but the army really taught me one thing, that is, I was never going to get a job and work for anyone else. So that sort of made me a slightly unusual character. I originally thought I was going to go off and be an entrepreneur and set up businesses, and went off to London Business School back at the end of the 80s. Very fortunately, the accountant for my company persuaded me to become a company doctor because he wanted to get out of accountancy. And so we spent the next 10 years between us learning how to deal with companies in financial difficulties. He would be an insolvency practitioner, advise them, and I would run them. And, I really learned about the problem of turning around businesses or dealing with businesses in distress. And certainly, I'd advocate it was sort of, it's more than an MBA. It's a sort of a real life lesson, learning about business, because you have to deal with everything. And off the back of that, basically, I decided that really what I wanted to do was use that experience to invest in businesses. So for the last 25 years, I've been investing in the turnaround of companies. So that's really where it's all come from. I researched turnaround for a doctorate, which was an interesting experience because it ended up being much more about psychology than anything else. So an unusual background.
No, that it makes a lot of sense though. So for people that don't, didn't go through all this experience you have with turnaround, what would you define as a company in distress or a distressed business? And what are the things that as an investor you're looking at to know some distressed businesses might not be worth saving? So how do you define distress? And then how do you know if there's actually potential for a business to turn it around?
So I think you're right to latch onto this, because the word turnaround can be interpreted as sort of business improvement, where a company's profitable, but it needs to become more profitable. My version of turnaround distress is very much if a company is not going to survive, in the next sort of 6 to 12 months, is running out of cash, but equally it can be, we meet companies that can't pay the wages on Friday. So, it is extreme end of distress. That's normally because most businesses don't actually seek help until very late in the day. It really takes a lot of courage for someone running a business to ask for help, in particular if it involves, washing their dirty laundry in public, so to speak. And don't forget, most businesses are run by successful people who've solved their problems along the way. They've become very resilient. They've really, had to deal with a lot of problems, and it's really difficult to know when is a problem existential, when is something not going to turn up and things aren't going to turn out right. When it comes to the sort of businesses we're looking for, and I say we because I've got a small team of people I work with. We regard ourselves as partners. The fact of the matter is, we're trying to help businesses that are in financial difficulties, but we're distinguishing between those we can help, but we don't really want to have an equitable or an interest in, and those that we definitely would like to be interested in. And the difference between the two is is, do we want to be an investor for the long term? Do we want to have shares? And do we really want to own businesses under our philosophy, which is, why would you ever sell a great company? So if our role is to not just save a company, and we'll talk about what that's involved shortly, but it's also to be owners, why would you want to sell it? And therefore you're thinking about a long-term investment, almost like a sort of family ownership type approach. And that's very different from the other side, where we're very happy to help businesses even when we don't want to be an owner, and we'll take a deferred fee. So our playbook normally is, we'll help save you. You can't afford to pay us, but we'll put skin in the game insofar as we expect to be paid if we save you, sort of thing. And that's often some form of success fee or deferred consideration. And so the investment piece for the long term is, what sort of businesses do we really want to own? And they're businesses that can defend themselves in the marketplace, that have growth potential. That's not all businesses. So, for instance, as an example, we're not particularly keen to own construction companies, although we help a lot of construction companies. There are certain businesses that we don't know a great deal about. For instance, truck businesses, the sale and purchase of trucks, maintenance companies. We're not really going to want to own them, and growing them is quite difficult. They're very intensive businesses. So we believe we can help, but we wouldn't want to own, if that makes sense. Whereas,
No, that makes, yeah.
Different industries, we might think, yeah, we definitely like to be involved in this industry, and we can make something of it because it's got huge growth potential.
And is that like, are there specific industries that it's typically, if it falls within this industry, then it would be interesting or worthwhile for you to look at being a long-term partner?
Cool. So it may help to think in terms of what are the sectors we like, and what are the businesses we've got an interest in. So the sectors we think we like are sectors where data, intellectual property are the main asset. And therefore we would like to sort of grow those, develop more intellectual property. Human capital we like, in terms of, systems and processes operated by good people. We found ourselves supplying products to the passive house and the efficient building industry. We like those sorts of future businesses that will be relevant, supplying building materials for the future, and own a few companies in that sector. We like businesses that have a mix of sort of consultancy and software, where it's more than just supply of software, but there's some human intervention that provides support for companies, but uses its software to sort of enhance the proposition. So it's more than just people. We have an interest in a blockchain company that's trying to revolutionize the use of the blockchain to buy and sell investments, mutual funds, which is an interesting proposition. A while ago, I'd have probably said we wouldn't touch a brewery, and yet we find ourselves with an interest in a brewery, because what we've discovered is that we can collaborate with a partner to buy breweries, close down the brewing function, outsource the brewing, but keep the distribution of local beer to local distributors, distribution houses, pubs, restaurants, and therefore keeping the local feel of the beer, but centralizing its manufacture.
No, that makes a lot of sense. I have one question that goes back to something you mentioned earlier, and then I want to spend a lot of time talking about the actual turnaround process, because I think that will be very relevant. You mentioned people often don't ask for help until it's too late, or until we can't make payroll on Friday. And so do you have any advice if someone's listening and they know that their business is in trouble? Who do they reach out to? How do they ask for help? Because a lot of businesses that are in distress, you and K2 Partners are great partners, but not everybody has business's best interest in heart, and they may take advantage of that. And so, when should someone think about asking for help, and how could they go about finding a good partner to help them?
So we intentionally use the word partners because we want to partner with the owners of businesses for, the purpose of ensuring that that business is successful in the future, and become a partner with them in order to share in that future success. Now, not everyone wants a partner, but you can see how when they're in serious difficulties, where do they go for that advice that you're referring to? And one of the difficulties is that if they go to most advisors, management consultants, what have you, they generally all want to be paid.
Mhm.
They don't think like investors. They're fee earning, and and let's be clear, companies in distress are interesting. They're if you can turn around, it's a big credit. But most professionals expect to be paid. Finding someone who can help you can be difficult. The natural source of advice is the insolvency profession, and it's quite difficult because some of the members of the insolvency profession, they make their money out of insolvency. So is there a sort of a self-fulfilling prophecy if you go and speak to an insolvency professional? However, a number of them are, I would like to use the word enlightened, but they genuinely do turn around companies. The difficulty for anyone seeking advice is to know where to go and how to find the right advice, because it's relatively easy to speak to someone who's facing an existential event, can't pay the wages, to be susceptible to the advice, well, if you can't pay the wages, we should put you into a formal insolvency procedure. Whereas we might say, well, let's just have a closer look to see if we can avoid it.
Right.
And see what else we might be able to do. So you can see how this is where the investment view that we bring to the table is different, in that we are willing to invest our time and sometimes our money with a view to saving the business. But it's not for the faint-hearted, and there aren't many people who'll work for free in pursuit of that goal, especially when the company can't pay the wages on Friday.
Yes. No, that is my next question, because it's a high risk. It sounds high risk, high reward. Um, if you're able to turn around the companies, then there's high return because you're able to grow them and share in that. And so, with that, my guess is that you and your team have gotten pretty good and pretty confident in your ability to do a turnaround if you do the right setup up front. So, I'd love to understand more about who's a part of your team and your partners, and then what does a turnaround actually look like? What are the things that you do within a turnaround to actually start seeing some success?
Before I come to that, just let me
Mhm.
deal with the words high risk and high reward. Yes, there's an assumption there's a high reward, and there probably is a reasonable assumption there's a high risk. Certainly there's a risk that you spend your time and you might put in some money and lose it. But this is where, like with any investor, especially investors in startups, because there's a lot of parallels, the risks are there and the high rewards are there, but you have to have an appetite for getting it wrong. But also you have to know when, quite early on, it's an impossible task. So the risks are mitigated by quite a lot of experience, and therefore you can see how it makes life a lot easier for us to sort of bring that experience to the table and reduce that risk. And normally the risk is mitigated by a few early conversations with people who are owed money, who, for instance, might issue a winding up petition or pursue their money or pursue their debt. With conversations with key staff, are they willing to support an initiative to save the company? With key customers, can we rely on your continued support? And the same with suppliers. So you can see some relatively early upfront conversations. They're difficult ones, but they can mitigate risk of time and money. The rewards are more difficult because we are certainly in the small company market, sub 20 million turnover. And often companies, when you save them, they need to keep the cash. They need to preserve cash. So it's not a quick win. It's not a get rich quick model. And especially if you're going to grow those companies, they need to retain their cash. So you can see how actually a lot of the businesses we get involved with, we're not taking money out of, because we want to not just save them, they need to keep their cash. We often have to ensure that creditors and those who support the company through a lean period, in some cases, for instance, staff not being paid, they need to be paid ahead of us. And if they see us taking money out, they won't support us anyway. So we won't have the right culture. Similarly, once you are sorted out, and often there's a lot of money invested in not just saving the company, but putting in place the systems and the processes to grow a company, but you also then need to retain funds to fund that growth. And the reason I use the word growth is because certainly in UK, somewhere along the line, we've fallen into the habit of thinking that 2% growth is a target. Well, if inflation's at 2% and growth is 2%, then no one's growing. You're just putting up prices in line with inflation. So if you turn it on its head and say, well, if in 10 years' time we're compounding any growth, there's a huge difference between growing at 2, 5, 10% every year for 10 years to growing at 30 to 50% every year, 10 years. And the compounding effect on growth has an enormous impact on the need for cash. And since we don't like debt, we like to leave the cash in the company to fund the growth. So you can see it isn't get rich quick, but what we'd like to do is think that we have a strategy for building some super businesses. Now, the turnaround process is different. And I haven't met anyone who doesn't tell me how to turn around their company yet. So normally the solutions are interesting. But at the end of the day, it's all about people. It's people who are running suppliers who might be owed money. It's the staff, people on whom we depend to build the business. It's the people who run customers, who are running customers. It's confidence, but without being overconfident. It's courage without arrogance. So there's quite a lot of human dynamics with it. So I would argue it is all about people, and the way we approach that is by being brutally transparent, radically transparent with everyone, and recognizing that some people might use that transparency against us, but at least no one can hold us to account for not being honest with them, not telling them the truth, and not having integrity. And so hopefully we quite quickly get some support from those who are willing to support.
Yeah, so that's really interesting, because obviously you mentioned the systems that you put in place, but the starting point in business is built on people. And so I love the point you brought up of typically it's starting with difficult conversations, but having those honest conversations and seeing who's willing to be a partner and who's not. But so often people aren't willing to have that conversation. And so things just get swept under the rug for a long period of time. When companies come to you, help me understand, is there any commonality? You've mentioned a lot of times it's a personnel or I think you said psychological issue. Is it the business model? Is it that they got behind on cash? Is it they don't have a good leader in place? Is there any commonality in terms of businesses that you come alongside and turn around?
So you could argue that we're really talking about first, second, third order consequences. So if we focus on cash, all cash is a means of exchange, a means of buying something. And you might have heard of startups being encouraged to do things like bootstrap. And that's where you're trying to work out how do you get something without cash. And there have been some interesting crowdfunding initiatives where we'll give you, whatever, something for free for a few years, or and there are lots of ways of doing things, but money is normally a consequence, and it's running out of money that causes businesses to go bust. But so once one thinks of it like that, you can see how a lot of the companies we might meet may have raised money from shareholders. They may have had investors. They may have had venture capitalists. We love the software company or the company that's raised £10 million from venture capital and run out of money. Now,
Why
the
do you love
problem,
that?
because they've spent that money and they've normally done some great things with it, but they've
So
run out of money.
when you're talking about, the assets, having data, IP, typically, yes, there's something when you're getting an investment that large, there's some asset that they've built.
Yeah, no, I've just bought 6 subsidiaries in the biotech industry from an owner that's given up. They've spent tens of millions. The company was worth at one stage, holding company is listed on NASDAQ, was worth 600 million. And they've sold all 6 subsidiaries to me for £1.
Wow.
Within
Because
that,
they're just done.
There's some intellectual. Now, they ran out of money 4 months ago. It's not an easy call, but the point is, they've got intellectual property, they've got work that they've done. They've spent the last 6 years trying to develop saliva as the future for testing for infectious diseases, as an alternative to testing with blood tests. Well,
I love that
coronavirus, and we're
idea.
all taking our swabs and all the rest of it. So we're all ready now. We just need to finish off the research to prove that you can take a saliva swab and identify an infectious disease. Fantastic. The top company had run out of money. Now, what's really goes on? The companies that raise all this money are great on these great promises. What sometimes happens is, as in this particular case, they then think all they need is a bit more money. So they go and borrow some money. So no longer is it shareholder capital, it's debt. And if the turnaround or if the promise doesn't happen, the lender gets upset. And in this case, the lender wanted its money back. Well, it didn't get its money back from me. In order to save the NASDAQ company, I did a reverse takeover. It's now an AI company, and it sold off all its subsidiaries. I'm now the biotech company that was the listed NASDAQ company.
Wow.
Now, look, it's not an easy job. I've got to put it back together again. But there are some people who believed in the old company, and they're joining forces with me, and we're going to work it through. We're not going to get rich quick. We're going to work extremely hard, and I hope we can pull it off. But it was the debt that caused the problem, and calling in the debt is what often crystallizes the insolvency.
Yeah, and I mean, even the point that you brought up, because I've seen businesses that have a lot of debt, whether that's from suppliers or from investors or they borrowed money. And like we talked about, conversations, that is a key part. And often people will work with you if you're willing to have a conversation with them. But people are not willing or too uncomfortable to do that, to where they get put in a really sticky situation. So that's fascinating. So that's what I'm trying to understand.
Let me give you another example, okay? Because this is a mix of turnaround and startup and growth and all the rest of it. I've been running a blockchain company in the financial services industry for probably getting on for 4 or 5 years now. And the deal is this: we'll never run out of money. We raise money, but rather than borrowing money, what I do is I control all the agreements. So the first agreement is we have only one employee, and that was the founder. And the agreement with the founder is he only gets paid a salary when the company's raised some money. Sometimes we raise money and he gets a salary, and he goes on 0 hours or zero salary when there's no money left or not much money left. I keep money in the bank. But we also have lots of suppliers and people who do subcontract work and research work and R&D and things like that. The agreement with them all is you are paid upfront for work you're going to do. And if we haven't got the cash, we won't pay you. The agreement is also, we might agree to allow you to continue working, providing we accrue the liability, so long as we don't pay you until the company is sold or floated on a stock market. So what we've got is we've got this ability to call on people to provide services to continue working for the company without the company ever having a demand made in it for money. And after 5 years, the company owes quite a bit of money to these accrued liabilities, but we're continuing to raise money because the money that's coming in isn't going to pay them. It's going to pay for more services and more supplies and more investment.
But
We'll never run out of money.
that's the agreement up front. You're saying
Absolutely.
that's the key, is that it's everyone's clear up front. These are the
Absolutely.
terms. No one's
Absolutely.
surprised when they're not getting paid, because that's what we agreed to. That's
Well, they're either
fascinating.
paid up front for doing work, or they don't have to do the work. But some of them believe in the company and are happy to do the work against a future payment.
Wow. So for you, what does this actually look like for K2 Partners, of who all is involved with supporting you with all of these different businesses and personalities and models and all of it that you're going through? What does your team actually look like?
So there are 5 of us, and essentially they're like-minded people. A lot of people I meet want to do work in the turnaround sphere, but they need to be paid. They need to put money on the table. They need to pay their mortgages, fund their life, and I get that. But we're very radical in the way we communicate upfront. And those people, if we find a project and they can justify working on the terms, you get paid. If there's cash, you don't. If there's don't, it can work. The reality is the people who work with me and who've been my partners for a long time, they understand the model. And between us, we're building up a portfolio of equity, which is, I'd like to think, becoming more healthy. We also, because we turn companies round for deferred consideration, fees afterwards, we also have a little pot of income that we can spread around.
And that income is from previous companies you turned around that are now paying you deferred income? So that's funding.
We didn't take equity in. Yes.
Got it. So you had ones that deferred the compensation for once they were turned around. Now they're making money. They're paying you. You're using that to, pay your team. Everyone pays their mortgages. And now you're basically trying to grow your pot of companies that are going to do that in the future.
Yeah, as a general rule, you probably don't want to think in terms of mortgages, because you need to be reasonably comfortable to do this sort of stuff. It takes a while to build up that income. Look, we've got companies that we've turned around that have been paying us for many years.
How long does what's the quickest turnaround you've seen? And is there an average turnaround?
So this is always an interesting conversation, because everyone wants to think that, it's a universal thing. Everything's the same. So if, as I suggested, that turnaround is a psychology thing, the example I cite is Harley Davidson Motorcycle Group, HOGS. They initiated a cultural turnaround, a culture change in the business, which they formally abandoned after 14 years, deciding it hadn't worked. Which probably says it all about change and turnaround, and that is how is the change of behavior owned in any organization? And so you then start to sort of look at the world of culture change and turnaround, and you learn quite quickly that in the West, it's normally some highest paid person's opinion. The hippos are out there saying, this is what I expect you all to do, get on with it. And nothing happens because no one owns it. Whereas in countries like Japan, top management don't get involved with it, it's encouraged as a conversation, it's encouraged, and it's very much bottom up, and people talk about it, and then suddenly everyone realizes that things have changed. And so change is quite an interesting, and you can see how if everyone's going to talk about change for some time, that's probably not appropriate in a turnaround, because you might have a limited period of time. However, given radical transparency is the watchword or the phrase, if you get everyone together and everyone recognizes that the company is going to go bust, it's like a burning platform, you might actually be able to have the open and honest conversation with everyone that change needs to happen. And so you can do that very, very quickly. And if you can encourage everyone to come up with the change rather than telling everyone, they might, or they're more likely to own a change of behavior. And so I think very quickly you can actually inspire and encourage a fundamental change of behavior very, very quickly.
And you're saying by having them involved in the change conversation versus it being this is the change that's happening, being more of a, like I use the term co-creating, but letting people be a part of the conversation and not always the final decision, but letting them have a say in the broader picture to where then when it is decided this is what we're doing, they see themselves in that plan.
Well, let me turn it into something practical. So as a general rule, consultants normally speak to the management. And they'll ask management what to do, and then they'll read the watch and tell them the time. And the difficulty is that, you know, my personal view is if management know what the right answer is, why didn't they do it in the first place? If, however, you go onto the shop floor or you go to someone in dispatch or if you go to someone in sales or, you know, people who are doing the actual job and you have the same conversation, what is remarkable is often they'll say, no one's ever asked me that before, or, you know, or, well, I've been trying to tell everyone this, or, you know, but most things are fairly obvious to the people who are doing the work. If one has sufficient humility to listen to them and encourage them, you know, they know the answer. It's extraordinary. But you'd have thought it's easy, but it's not that easy because it takes an inordinate amount of human. And the biggest problem with any organization is aligning everyone around the same purpose. You know, what are we trying to achieve? But empowering people's a difficulty. And it's always a difficulty when you need everyone to be doing the same thing consistently all together. So doing that is not easy, but you can see how it does have the basis of the solution. And don't get me wrong, you can't keep everyone's job. You can't, you know, sometimes the obvious answer is to close the factory and outsource manufacturing. Laura Ashley is a great example. I don't know if you've heard of it as a retail shop, but it was a very successful retail shop in the 80s in the UK, and it's been through many, many, many turnarounds, selling, you know, essentially English country garden type homeware and clothing. Very recently, they've been acquired and they've now become a licensing business model. A fundamentally different. The products are still the same, but the business model has changed. So there are normally lots and lots of things that need to be thought through. You know, you may have heard of a company called Costa. They're a coffee shop. Well, we met a company called Coffee Nation years ago, and they were trying to sell coffee machines. Well, we didn't think anyone was going to buy a coffee machine for £12,000, but we did think that we could probably trial one in a service station and see if people, when they fill up their car, would like a cup of coffee. Well, they were prepared to pay, you know, £1 or £2 a cup of coffee, but the garage couldn't see its way to buying the coffee machine, but they were very happy to share the revenue from a cup of coffee. Well, as long as we could supply the machines and share the revenue, garage wasn't taking the risk. We just have to change the business model from one of selling coffee machines to buying them, installing them, and then sharing the revenue. Well, it's
Yeah.
obvious in hindsight. It's now called Costa Express.
And
Coca-Cola
I like,
bought it for about $3.2 billion.
and it's such a fascinating one, even thinking about the brewery example that you used of people get into businesses and, can sometimes have blinders on if this is the business that we got in, this is the business model versus being very creative with thinking, what are different structures? What if we're no longer a brewery that makes our beer in-house? What if we are just a distributor for someone else's beer? So I think it probably does take someone from the outside just coming and questioning it, though, pointing out what different possibilities are, where people who have been working in a business for 10, 15 years, they've been doing it the same way. It's probably difficult for them to imagine there's other options.
I mean, there's so many examples, and it does require some imagination, some creativity, some risk taking. One of the difficulties is this: as soon as everyone sees a new business model being successful, lots of others will jump on the bandwagon. So, competition is a real challenge, and that's why trying to have some sort of moat around your business model, whether it's intellectual property or systems or some protected piece of your business or something that you don't share, some skills that you have, it's always a challenge.
Right. But it's such a good point of actually having a moat, which makes sense. So that's why those are the types of businesses you're looking for, having some sort of asset versus something that someone's able to just copy the model and copy it. Okay. So as we're wrapping up here, I would love to know, what does the next 12 to 24 months look like for you and the K2 Partners team?
Personally, I'd like to spend more time sailing.
Yes, yep. I know you told me this story where I think you took a business meeting from the back of a yacht while somebody else was driving. So that
a month and a half ago, I was sailing around the Greek islands in October, and I like to hire a boat and go sailing a couple of times a year. And the lawyers called, and we spent an hour and a half on the phone. But the boat was set. The sails were up. The auto helm was on. We didn't need to change course, and so it was an easy conversation. I even think I had a drink in my hand.
just maybe. So, okay, you want to sail more. Totally fair. Anything else that you're hoping in the next couple of years?
It's different. Look, the challenge and what I'm trying to do is build K2, and for me, I'm really keen to find 2 or 3 more people who are comfortable with our model so that we can do more. We're not trying to grow quickly, but we've got a really super business model that thinks like investors, attracts people with some experience. We have a process, we have systems. We unlike most turnaround people or company doctors who are all individuals, we do try to work together as a team, support each other, have each other's back. So, it's a privilege to have such amazing partners. It's a joy to work with others, and so we've almost got 2 layers of partnership. We've got ourselves and then the businesses we work with. So, it's not get rich quick. The next piece of the challenge is succession planning for the businesses and for the ownership, and it's trying to help everyone see themselves as an owner, not a manager, if that makes sense, so that over time you make yourself redundant, and that frees up your time to do other things, invest in more businesses or invest in time in looking at other options or growth opportunities and things like that. And then for me and my partners, it's to help our children become more involved with the business.
Oh, that's fantastic. That's very exciting. Okay, this is all great. If people either want to, I think there could be a couple different people that would reach out. If someone is interested and we like the business model, we have expertise in an area. And then the other is, if there's a business that is in distress, what is the best way for them to reach you or reach K2 Partners?
Sure. Well, first of all, anyone in distress, you don't have to name your name. Our numbers are all over the place. We'll be very happy to have and in confidential conversation, happy to sign NDAs, happy to help people and genuinely help people, because we're not expecting to be paid by people who can't afford to pay us. Finding us is easy. My name, Tony Groom. I'm all over the internet, LinkedIn, K2 Partners, K2 Business Partners, k2-partners.com. We should be relatively easy to find as long as you remember K2 Partners, K2 Business Partners.
I will make sure to put links as well to just make it really easy. And I just so appreciate, there are a lot of businesses in distress that do have potential, that do have good people leading them. And I think it's amazing what you're doing for these business leaders who had an idea and to give them an opportunity to see their business continue, period, and then hopefully flourish at some point. So Tony, thank you for coming on, educating. I love the term company doctor. That is not one I've heard before, but I think that's what I'm going to call you from here on out. Tony, the company doctor, because it explains what you do really well. So thank you so much for coming on.
A pleasure. And thank you very much for having me on, Beta.
Yeah, absolutely. Bye.